This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Strong rebound. Stocks have their best week in years as the bulls appear to have regained control of Wall Street. Coke's Fizz. What this blue chip American company is doing to battle a shrinking market for its core products. Hollywood game changer. Why a new superhero movie could be a turning point for the film industry. Those stories and much more tonight on Nightly Business Report for Friday, February 16th. Good evening, everyone, and welcome. I'm Sue Herrera. Tyler Matheson is off tonight. What a comeback. The S&P 500 posts its best weekly gain since 2013, following a week that saw the biggest drop in stock market history. The climb higher was not only big, it was broad. After a big run-up this morning, stocks pulled back when special counsel Robert Mueller indicted several Russian organizations and individuals for allegedly interfering with the 2016 presidential election. But the decline was brief, and the Dow and the S&P posted their sixth straight day of gains. The Dow rose 19 points to close at 25,219. The Nasdaq fell 16, and the S&P 500 added 1. For the week, the major averages were all up 4% or more. Mike Santoli takes a look at what could test the market next.
The stock market's impressive comeback in the past week has been almost enough to make investors forget the short, sharp drop that preceded it. The S&P 500 has recovered more than two-thirds of the 11% loss suffered in the prior 2 weeks and is now up more than 2% for the year to date. As encouraging as the rebound has been, investment strategists say there still are a few tests ahead of the market that will signal whether stocks are back on firmer footing. First is the level of the indexes themselves. Rallies that come after a dramatic sell-off often initially recover 1/2 to 3/4 of the ground lost before faltering again, as investors take the chance to sell shares near the former peak. The S&P 500 is right in a zone where it might be expected to stall out if this pattern were going to happen. The second test is valuation. The market correction made stocks appear less expensive relative to corporate earnings that are still growing nicely. Yet before January of this year, stocks during this bull market had never been as highly valued when compared to bond yields, a common way to gauge the attractiveness of equities. So if the 10-year Treasury yield stays near the current levels, just under 3%, investors will need to show they'll tolerate still higher stock valuations if the indexes are to challenge the former record highs set in late January. And finally, the market will probably need simply to calm down if stocks are to mount a sustained push higher. After one of the calmest years on record in 2017, volatility has swept the market in recent weeks, and even with the recent rebound, measures of market jumpiness are still a bit elevated. And bullish investors are looking for them to retreat toward more normal levels to indicate a return to stability. So while the bull market has certainly won back the benefit of the doubt with one of its strongest weeks in years, it's a bit premature to sound the all clear for a new rush to fresh record highs for stocks. For Nightly Business Report, I'm Mike Santoli.
Let's talk now about the strong rebound that stocks managed to stage this week and what might be ahead. Here to talk about that is John Augustine, Chief Investment Officer of Huntington Private Bank. John, nice to see you. Welcome.
Thanks, Sue. Good to see you.
What did you make of what happened over the past 2-week period? A lot of people are saying it's the end of the bull market, the beginning of increased volatility. Others disagree with that. Where do you come down on where we are now?
Well, what caught our attention was the catalyst to bring us down a week ago Friday or so was coming from a position of strength. It was coming from a better than expected jobs report. And that kind of brought all markets down, not just in particular stocks, but commodities, gold, bonds as well, with bond yields going up. So that was the first thing that caught our attention. Then we all learned about the VIX and how it can accelerate to the downside a week ago Monday or so, which was a surprise to us. So out of that, what our thought was once the stock market regained its footing, time to rebalance, because again, all markets had kind of come down. So we were surprised by the VIX. We knew we were coming in from a position of strength. We didn't see a big asset allocation adjustment taking place. So our counsel began to look at one of rebalancing, then look at moving into positions of strength within stocks, those that have been taken down sharply. So that was our view coming in, Sue, when we saw the volatility first pick up.
So were you doing some buying, and do you feel as though perhaps with more volatility, the market can continue to move higher?
Yes. So yes and yes. We were doing some buying. Our equity teams were looking at stocks they'd been looking at that just hadn't come down very much. Amazon was one of those stocks. Nucor Steel was one of those stocks. Lockheed Martin was one of those stocks. So they were looking at upgrading stocks that just had never given them that break, so to speak, to buy. So that was first and foremost. Our equity teams were active. Secondly, in volatility. In volatility, just so one asset class, in our view, isn't getting picked on in relation to the others, they all kind of came down this time, but stocks got accelerated from the VIX. In that moment, then we saw VIX start to lower. So in summary there, we're starting to see the VIX back in the teens. Could it go back in the 20s? Yes. Unless there was some fundamental change in earnings, inflation, or the economy, at our shop at Huntington, we'd probably be looking to rebalance again and swap into positions of strength. So that would be our view right now, where the VIX and where the markets are.
All right, John, we'll leave it at that. Thanks so much for joining us. Enjoying the long holiday weekend.
You too.
John Augustine with Huntington Private Bank. Dow component Coke reported flat sales of its soda. The company's quarterly results were helped by stronger sales of things like teas, coffees, and vitamin water, and that helped send shares higher. But what, if anything, can this iconic American company do to stem the decline of its product that it's known for? Dominic Chu takes a look.
When you think of Coke, you think of fizz. But business at the world's largest beverage maker is fairly flat. Its namesake product isn't the hot item it once used to be. There's no real growth in traditional soda like Coke and Diet Coke, and that's a problem not just for Coca-Cola, but for the entire non-alcoholic beverage industry.
Some of it is a realization that, and especially if we're talking about carbonated and sugary type beverages, it's realizing you're never going to convince some people. And so focusing on their other strengths. For Coke, it's, hey, focus more on vitamin water, focus more on smart water, focus more on the carbonated beverages without sugar.
Changing consumer tastes and buying habits have become a real challenge for some very big snack and beverage companies. For Coca-Cola, the bright spot was outside of its core product. Water, sports drinks, teas, and coffee products. Those segments posted modest growth. Sales actually fell modestly for its juice and dairy products. In the coming months, Coca-Cola will be focused on certain key products and markets.
They've changed to smaller, like minis, because you might walk into the store and say, I don't want 20 ounces, but I am kind of thirsty and I do like the taste of Coke, so I'll take a 6-ounce version. And they don't, not only are they, getting you to try more occasions and driving volume, but the price per ounce for that mini is substantially higher than if you were going to pay for a 20 ounce.
Investors in both Coca-Cola and rival PepsiCo will be watching very closely to see if each company can find a way to boost sales momentum, whether that's in the new versions of existing soda lines or investing more in other growing markets like sparkling water. For Nightly Business Report, I'm Dominic Chu.
So Dom set the stage for us. Let's take a closer look now at Coca-Cola's quarterly earnings and talk about where that beverage giant might have found growth. Joining us to talk about that is Sonia Vora. She's the equity analyst at Morningstar. Welcome, Sonia. Nice to have you here.
Thank you for having me.
How do you view the company overall? Dominic kind of set the stage with what their core holdings are, but how do you feel about it overall?
Sure. So we think that Coca-Cola's fourth quarter results largely came in line with our expectations. As was alluded to, a lot of the drivers of growth are related to pricing and better price and mix strategy. However, we were also very pleased to see the company's gross margin expand significantly during the quarter as it concluded the refranchising of its U.S. bottlers. We think that the shift to a concentrate model as the company refranchises its bottlers actually will provide a lot of upside in profitability. A lot of the bottling assets were more capital intensive, and without those assets, we see a lot of potential for the company to improve its gross profit and its returns on invested capital.
So where do they find continued growth? They've moved into vitamin water. They've moved into non-carbonated drinks, certainly, but they're still known as Coke and for Coke. So how do they find that growth? Do they have to do acquisitions? How would you advise them?
So right now, a lot of growth has been driven by pricing, and that's consistent with what we're seeing across the non-alcoholic beverage space. About 2/3 of the organic growth this quarter was driven by price and mix. So smaller package sizes, different channels, maybe prioritizing a small bottle in a cooler versus a bulk amount of soda on the shelf. These things are great for profits and also will drive top-line growth. Down the line, we've also seen the company push innovation into categories like coffee and tea, which were up 2% during the quarter. And continued growth in its non-carbonated beverage portfolio should help the company better align its offerings with consumer tastes.
Do you view their potential bigger domestically or internationally?
For soda, I would say that the volume potential really exists abroad. But in terms of pricing, we've seen strong domestic pricing, with pricing in North America up 2% this quarter, lapping about a 5% increase in pricing this quarter of last year.
What about other things like, we've seen Pepsi and other competitors move aggressively into snacks and things like that. How does Coke rate on that front?
I would say that I see Coca-Cola staying purely in the beverage space, but within beverage, they have started to diversify away from carbonated kind of traditional soft drinks and toward non-carbonated beverages, like their push into coffee recently.
All right, Sonia, we'll leave it there. Thank you so much.
Thank you.
Sonia Vora with Morningstar. In economic news, consumer sentiment climbed to its second highest level in 14 years. According to the latest read from the University of Michigan, tax cuts offset the recent volatility in the stock market. Economists watch this survey closely because, in theory, the better people feel, the more they spend. And spending accounts for a large chunk of economic activity. Construction of new homes rose nearly 10% in January, and that's the second highest level since the Great Recession. While single-family home building increased last month, so did construction of multifamily homes. Permits for groundbreaking on multi-unit residences soared to their highest level since the end of 2016, and that's creating a bit of a mess in the apartment market. Diana Olick has our report.
Scan the downtowns of the nation's largest cities, and you're likely to see a staggering array of cranes. Most of them are helping to build luxury apartment buildings. In fact, multifamily construction is now at a 40-year high. Completions last year jumped a staggering 46%, more than doubling the long-term average, according to RealPage. The trouble is, developers are putting up the wrong kinds of buildings. Luxury, not affordable.
It's really tough to deliver product at those lower price points. The cost of land, the cost of building materials, the cost of labor, it's really about the same regardless of what product you're doing. And it's just tough to make a deal work financially if you're going toward that middle market price.
Developer Toby Bizzuto faces ever more difficult financing on every new project. The Bizzuto Group has a portfolio of about 70,000 units, mostly in the luxury space. His tenants spend a relatively low share of their high incomes on rent.
That being said, it is a tale of two cities. In the middle income and the lower income market, people are spending proportionally more on their rent. So much so that I believe there's an acute crisis headed our way.
Despite rising incomes, nearly a quarter of all renter households spend more than half their income on rent. That, according to Harvard's Joint Center for Housing Studies. Non-luxury rents continue to rise because of the short supply. So why don't developers just put up more affordable product?
A 2x4 doesn't care whether it's in a luxury building or in an affordable building. It costs the same. The differential, of course, is the rent. And there's a huge disparity in high-end rent versus low-end rent. So the issue is that for us to develop an economically viable, feasible project, it has to be, by its very nature, be high-end.
Not what most renters today really need. For Nightly Business Report, I'm Diana Olick in Washington.
It is time to take a look at some of today's upgrades and downgrades. Wendy's rating was raised to buy from neutral at Guggenheim. That firm expects margin improvement and says the stock is attractively valued after its recent decline. The price target is now 18. Wendy's up 4% to $16.39. Biogen's rating was cut to hold from buy at Argus. That firm cites drug trial delays and competition for its multiple sclerosis and Alzheimer's drugs. The analyst describes the outlook as challenging. The stock fell 2.5% to $291.87. TrueCar was named to the Best Ideas list for 2018 over at Stevens. That firm expects the automotive information website to unveil a number of enhancements to its operations. The analyst recommends buying the stock on any weakness following its mixed earnings report yesterday. The price target is 18. The shares fell 6% to 11.18. Still ahead, why talk of tariffs sent steel stocks soaring. The Commerce Department is recommending steep tariffs on foreign steel and aluminum. While no decision has been made, Commerce Secretary Wilbur Ross said he felt strong measures were necessary, and that was enough to send steel stocks higher. Kayla Tausche is in Washington tonight with the details.
The Commerce Department found cheap imports of steel and aluminum have flooded the U.S. in recent years. The agency is recommending that President Trump put restrictions on imports to restore U.S. production to 80% of capacity. Steel plants now are running at less than 3/4 of capacity and aluminum less than half. There are three categories of recommendations: blanket tariffs affecting all imports into the U.S. The second, targeted tariffs for certain countries, which would exclude Canada and NATO allies except Turkey. Finally, a limit on the amount each country could export to the U.S. The steel and aluminum industries have urged Washington to consider strict penalties that would preserve their businesses. Todd Lebos, CEO of Majestic Steel, was on Capitol Hill this week to push for action.
We need to have a strong domestic steel industry. Without a strong domestic steel industry, it's proven that could be a major risk for our country, whether it comes to national security or infrastructure or just general economic needs.
But some worry action would lead to higher prices and escalate trade tensions with China and other U.S. trading partners. In a statement, the Business Roundtable said, quote, "We are very concerned that using this tool will hurt the overall U.S. economy and American companies, workers, and consumers." While the recommendations are for strong action, this isn't the end of the story. Commerce Secretary Wilbur Ross made clear not everyone in the administration agrees, and President Trump has until mid-April to decide what, if any, action to take. For Nightly Business Report, I'm Kayla Tausche in Washington.
A recovery in America's farmland helped the results over at Deere. That's where we begin tonight's Market Focus. The world's largest farm equipment maker is seeing stronger demand and reported rising sales in its key markets. The company topped analysts' estimates in the most recent quarter, and it raised its sales forecast for the year. Deere rose 1.5% to $169.44. Campbell's Soup reported a decline in soup and juice sales despite posting better than expected profits. The quarter was also hurt by an ongoing dispute with Walmart over a promotional program. The stock fell 3% to $46.17. Retailers are stocking fewer products made by Kraft Heinz, and that hurt that company's bottom line. It comes as competition increases and Americans opt for healthier meals, a trend that's been pressuring processed food makers. Shares fell more than 2% to $70.80. And VF Corp, which owns the brands North Face and Wrangler, reported disappointing earnings and said it's planning to sell its Nautica business. The apparel company wants to focus on its best performing labels. The stock was off 11% today to $74.64. And Wynn Resorts founder Steve Wynn will not receive any severance payouts after he resigned from his post following sexual misconduct allegations against him. Wynn was at one point eligible for a package totaling more than $300 million. The casino operator also said that it was still considering removing the Wynn name from the brand. The stock rose fractionally to $164.28. It is time now for our weekly market monitor, who has three picks he says have reasonable valuations and can weather this period of increased market volatility. The last time he was on in September, he chose Accenture, up 24%, Arch Capital, which is down 7%, and Carnival, which is flat. He is Michael Muscio, President and Portfolio Manager of FBB Capital. Welcome back, Michael. Nice to have you here.
Pleasure to be here. Thank you.
And congratulations on a couple of those picks. Let's get to your new ones. And your new picks tonight are J.P. Morgan. You're helping us to kind of negotiate all the volatility that's out there.
Yeah, so I think that with the additional volatility or volatility back in the market, focusing on high quality is going to matter going forward. And so we're looking at kind of industry leaders, and J.P. Morgan is best of breed and has a little bit less execution risk than Citigroup or Wells Fargo currently. And so we like the name.
You find it fairly valued?
Yeah, it's actually a little bit undervalued from where we think that the stock should be, and they're raising the dividend 10% a year. We see a double-digit return as interest rates continue to go up.
Next is United Healthcare. I think you've recommended this one to us before, if I'm not mistaken.
We have. It's been a couple years, but we still like the stock. We recommended it before at a lower price in terms of share price, but valuation is of kind of similar level today, even though the share price has increased. And they have a first mover kind of advantage in the healthcare space, in addition to the insurance business, and some of the others are trying to catch up. So we think they're likely to take market share, and again, a reasonable valuation.
The consolidation, though, that's going on in that business has been kind of going at breathtaking speed. You feel as though they have an advantage, even with all the mergers that we're seeing with the pharmacy benefit managers and the like?
We do. In fact, we think a lot of the merger activity is a result of the rest of the industry trying to catch up and become more competitive with United going forward.
Let's move on to the third pick, Honeywell. A lot of people on the street like Honeywell. They've really managed to execute, and as you can see, they're up about 24% on a one-year basis. What do you see in that company that you still like?
So they're divesting of some of the old line businesses right now and refocusing on the aerospace and defense business. Aerospace and defense names, as you know, Sue, have done very, very well over the last year and a half. Honeywell has also done well, but there's a little bit of a discount in terms of where it's trading to the rest of aerospace and defense. And if they continue to execute, we think that they're likely to catch up, and investors will be rewarded. Again, they've been raising their dividend at 12% a clip a year as well, so investors get paid while they wait.
You know, we've been asking all of our guests this evening what they were doing for their clients and with their money over the last 2 weeks with the market volatility. What were you guys doing over at FBB?
Yeah, so as we had cash to deploy, we did that. We bought some stocks in the consumer space. We added to the Honeywell position a little bit to clients that were light. I will admit, when the market ticked down on that Monday, down 7, down 1,200, down 1,600, we kind of stepped back and took a breath and said something's unwinding here that we don't understand. So in that environment, like anyone else, we feel it's best to kind of wait until we get some additional information. And but that's on the whole, we were buying.
I think you had a lot of company in stepping back and watching it.
Yeah,
Michael,
that's right.
Thanks so much. Have a great weekend.
Thank you, Sue. Take care.
Michael Muscio with FBB Capital. Coming up, a new film and a pivotal moment for Hollywood. Cyber attacks cost the economy as much as $109 billion in 2016. That's according to a new report from the White House. The intelligence community is quoted as saying that Russia, China, Iran, and North Korea are the main foreign actors responsible for much of that malicious activity. Google is testing a system to help locate 911 callers. It's working with a startup that we told you about a while back. It was called Rapid SOS. The existing 911 system has struggled to pinpoint the exact locations of cell phones, which today make up the majority of phone calls. According to the Wall Street Journal, Google's system was able to better locate people in an emergency, reducing the time it takes for EMS workers to arrive at the scene. A new movie from Disney Marvel is expected to have a big opening weekend. It's also expected to usher in a new era for Hollywood. Julia Borston explains.
Marvel's Black Panther is off to a massive start, grossing over $25 million in Thursday night previews. As Fandango's fourth biggest pre-seller of all time, behind only the last 3 Star Wars films, it's expected to bring in more than $175 million at the U.S. box office this weekend, a February record. That's bolstered by rave reviews, a 97% positive Rotten Tomatoes critic score that's higher than any Marvel movie or any superhero film from Warner Brothers' rival DC Comics.
I think there's been this kind of concern about superhero movies. Are they just too kind of cookie cutter movies lacking diversity that we see in the world around us? And I think part of keeping them fresh is to migrate into the more diverse world that we see. And I think that this movie is kind of an attempt at that.
The film, which cost a reported $200 million to produce, is expected to drive Disney to an even bigger share of the box office this year. Perhaps most important, Black Panther is defying assumptions that films with diverse casts don't perform particularly well, especially overseas. And now, industry watchers believe that performance of this movie, demonstrating the broad appeal of a predominantly Black cast, could prompt Hollywood to embrace more Black protagonists.
I think this is a watershed moment. If Black Panther does what most people think it's going to do, especially internationally, I think studios are really going to reconsider the reluctance in the past to diverse casting on these big budget movies.
The Hollywood Reporter's Bellany predicting that studio franchise films will start looking different now that Hollywood has a template for a successful movie driven by an entirely diverse cast. For Nightly Business Report, I'm Julia Borston in San Francisco.
And before we go, here's another look at the wild week on Wall Street. The Dow rose 19 points to 25,219. The Nasdaq fell 16. S&P 500 added 1. But for the week, the major averages were all up 4% or more. And that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us. Have a great weekend. We'll see you Monday.